Hi, I'm Peter Tershwell with the Journal of Commerce, and this interview is with Benjamin Gibson, who is a freight derivatives broker with Clarkson Securities, and he's going to be talking about freight rate derivatives. Ben, how is the effort going to educate the shipping business about container freight derivatives?
I think we're seeing some good progress. One of the most interesting things that we've seen in the lead up to TPM Asia this year has been the FMC changing their guidelines for US shippers about the use of index-linked contracts. And it's certainly encouraging for us to hear indices and the whole topic of hedging contracts using derivatives being brought up on the main stage at TPM as well.
It was indeed, because you had Rudolf Sade of CMA CGM citing indexes to be used in service contracts as a way forward that he would recommend.
Yeah, I think we're seeing from some of our customers a real desire to try and work more closely with shipping lines to build a contract that is stronger and more performable going forwards. And the use of an index allows you to do that. It allows you to make a real service commitment, and I mean that both in terms of volume, but also in terms of agreeing perhaps a certain parameter of schedule reliability or environmental performance with a carrier, making that part of the contract and removing some of the old price risk issues that have plagued the industry in recent years.
So it sounds like what you're doing in order to promote the use of derivatives trading in the container shipping industry is you're saying that before that can even occur, service contracts need to be put in place that eliminate or deal with price volatility by tagging prices to indexes.
Yes. It is, of course, possible for a company, particularly if they have a lot of exposure to spot freight rates, just to go ahead and use a derivative contract to hedge that exposure. But we think it's a more sustainable way for the industry moving forward to try and look at a new form of contracting that, as I've said, really takes steps forward in the strength, the performability and the service levels included in the contract. But of course, what an index-linked contract doesn't do is manage your price exposure. And that's where the derivative market comes in. Brokers such as ourselves are offering pricing and contracts that allow our customers to minimize their exposure to volatile freight rates. And at the same time, the index-linked contract handles all of the actual physical freight requirements.
And one of the things that we also heard at TPM Asia this year was that volatility in container freight rates, if not being here to stay, is certainly here with us for the foreseeable future.
Yeah, we do a lot of work with our research division at Clarkson's, and it's certainly true to say that the fundamentals at the moment point to some rather dangerous levels of oversupply in the main east-west trades. Certainly the current order book for the container industry is very much weighted towards larger container ships, those of typically 8,000 TEU plus, and again, that would put more pressure going forward, particularly on the Asia-Europe trade. That, coupled with the obviously well-documented worrying macroeconomic picture at the moment, means that volatility is certain to continue for the next few years at least.
And also in your the presentation that you gave in the Container Freight Derivatives Association workshop that you just did here in Shenzhen, you were talking about how index-based contracts are beginning to show up in the U.S. because the Federal Maritime Commission has told you that they're receiving those types of contracts.
That's right. And we're obviously working closely with some of our clients to help develop those contracts and help educate the carriers to offer them. And I think that that's a real sign that certainly the shipper community, and in particular the US shippers, want to try and evolve a stronger form of contract that can deal with some of the volatility issues that are bound to occur in the next few years.
Is it also a premise that if price can be taken off the table as an issue in shipper-carrier contracts, that those two partners are going to be able to focus on the real issues of service that are going to lead to more value being created throughout the supply chain?
I believe so, yes. we often hear on the main stage at conferences like here in Shenzhen that we're not going to talk about price here, or people going on and on about service, but neglecting to mention that shippers and carriers alike are businesses, and businesses need to be run for a reasonable rate of return for their owners or shareholders. And that's something that the industry really needs to grasp hold of moving forwards.
Right. Well, thank you very much.
Thank you.